Good morning and welcome to our 2024 annual budgeting and forecasting workshop. This is going to be a jam-packed session. You're going to want to be prepared to take some notes because we are not releasing any presentation, I'm sorry to say, because we only have a few slides, and the rest of the information we're going to be presenting will be shared live out of our MetalMiner Insights platform to give you the latest numbers and all of that. So a couple more housekeeping items. I've gone through what I just mentioned. You have a chat box on LinkedIn. Please feel free to use it. Ask us anything. We are all here to answer your questions. We've got 4 of us analysts on the call. So anything that's bothering you, anything you're thinking about that you've got an issue with your 2024 negotiation, if there's a weird or obscure metal that we're not covering today that you really want to get more information on, throw it in that chat or reach out to us directly. We're happy to address that. So just keep using that however you see fit. I'm going to walk through the macroeconomic overview and explain what we look at, even though there's a ton of information out in the markets. I want to share with you what we look at and why we look at it, and in particular, how it relates to metal markets, which is why we sort of take a narrow track in terms of what we look at from a macro perspective. Then I'm going to flip the conversation over. My colleague Stuart is going to give us an aluminum outlook. Stuart's based in the UK, has a really great global perspective, and we'll walk you through what we're seeing. And again, we'll kind of show that through on the live site. Then we will switch over to my colleague Nicole, who will cover the copper markets and our stainless steel outlook. Nicole has been tracking those markets diligently and has been speaking with service centers and others outside the industry, or in the industry, but outside of our company, and has some interesting perspectives to share there. And last but not least, Don will walk us through a steel outlook, looking at the 4 forms of flat rolled steel. And then I'm going to share with you a number of resources that we have from MetalMiner, both free and some of our subscription services. So with that, I'm going to get into the CRB, the commodity index. And what I want you to do here is just jot down the indexes and the things I talk about, just the names, and just write down, what are we saying? Sideways, up, down, etc. And then I'm going to kind of wrap it for you in a summary slide that explains the importance of each. Okay, so the commodity index, why do we track it? The commodity index is a great indicator of all commodities, of which oil is the largest, but also metals are a subcomponent. And if you're looking at this chart, and I'm giving you a really good long-term chart here, if you conclude that the market has risen and it's high and it now looks like it's trading sideways, that would be the correct conclusion. The commodity indexes are trading sideways. As you see here, we've had like this peak, which obviously was kind of the post-COVID, peak in prices, the war in Ukraine, all of that kind of, led to that peak. And since then, we've been sort of wobbling and trading sideways. That being said, there's a lot of volatility still less in metals markets, but much more in some of the other markets that we're talking about. So we're still seeing a lot of volatility. For example, for a lot of food commodities have seen, 2023 price rises. And of course, right now, oil has been somewhat range bound, but energy prices are also rapidly moving. So those are the things that impact the commodity index. And I'll come back to why it's important in just a moment. Now I'm looking at the DB base metal fund, of which several non-ferrous metals are included in this index. And again, if you look at this, and the chart's a little bit distorted, but essentially it's kind of telling a similar story. If you look at this, your takeaway should be, okay, we had that run up just like we did in commodities, and now we're looking somewhat sideways. So a sideways market. Again, what's the conclusion here? Sideways for DBB, sideways for CRB. It means that the market hasn't made a decision as to whether or not it's going to be bullish or bearish. It's kind of trading a bit range bound, and my colleagues will highlight some of the details around that in a few minutes. Okay, oil, again, the story, the narrative here is really, you can see even this is just a 3-year chart, right? It's kind of trading sideways. It's been a little bit up very recently. So we're watching this inflection to see if it's going to go higher than prior resistance levels, what we call resistance levels or prior peaks. So again, right now, oil is still in somewhat of a sideways trend, but definitely is the most subject to some sort of supply shock. Geopolitical tensions are the things that impact oil prices quite readily, or easily rather. And of course, oil being 30% of that CRB index that I showed earlier gives you a better understanding of why we have to track oil as well. And I think another piece you're going to see is that oil correlates well with some of the metals that we're going to talk about today. And I'll come to that in just a moment. Okay. This is the China large cap ETF. It's the FXI global shares. Why do we track it? Some people track Chinese PMI. They find that the metric that matters the most. We have not, and for a lot of different reasons. The PMI is really good for tracking producer price inflation. If you're interested in understanding what's going on from, a Chinese perspective on producer prices, that might be, the PMI might be a better resource. We track that in our monthly subscription service, but we look at this gauge to help us understand what's the overall health of the Chinese economy. And again, from this perspective, and again, I didn't go back too far, we're a little bit shorter here on length, but it's coming off, right? Demand is sluggish, and post kind of the everyone came back after COVID, you can see the markets have been sort of tailing off, and only recently we've seen a little bit lift, but again, we're not climbing above these prior peaks, which tells us the Chinese demand is sort of sluggish. Why is Chinese demand so important? You're going to see when I show you our correlation table, the importance of what's going on in the Chinese market. And from this perspective, we look at this index particularly to understand what does demand look like in China, not so much what the prices are, but what does demand look like. And what we're seeing here is it's sluggish, and that's why we haven't seen, I think, these big price run-ups that a lot of people had anticipated when the year started. Okay, US dollar index, super duper critical metric that we do pay very close attention to. And this is really important for metals markets. I can't stress it enough. So there's an inverse relationship, which I'm going to talk about in the next slide. But the criticality here is just to watch. We were, as you saw back in October of last year, September, October, we saw this great run up in the US dollar, which of course made it great for us to go on vacations, but it was at an all-time high. When the dollar's at an all-time high, the commodity prices, or rather metal prices, tend to be inversely related, so they're much lower. So what's been interesting has just been this sort of downward progression of the US dollar index, and there's a lot of chatter about where is the floor going to be for the US dollar. So we think the floor, it's in and around the floor right now. So if it were to drop, when I say the floor, this is probably 102. I think the significant threshold is 100. If it falls below, this is the DXY, falls below the 100 index, then it becomes much more significant for all of us. Again, because we can see a change in trend in metal prices. Now, this looks like an eyesore, but let me tell you, or let me share with you where I think you should pay attention or why it matters. So we're looking at the light yellow and the green boxes. Obviously, when you see 100%, it's just correlating itself against itself. We use correlation analysis strategically. These relationships change over time. If I were to show you this graph from 2021, it would look different. I'm showing you the last 3 years. Why? Because it makes sense to understand what are the relationships between these macroeconomic drivers that I'm kind of laid out and the individual metals that we're going to talk about in a few minutes. So for example, it's important to understand there is a fairly strong correlation between the commodity index and the dollar index. They move together, and that's a pretty strong correlation. What's unfortunately hard to see, but equally as important, maybe even more so, are negative correlations. By the way, when we have something correlated, at point, when you see like 85% or higher, that's what we consider to be a significant correlation. 70% means, I wouldn't bank the company money on that kind of relationship. So we look at the green ones and then the very strong negative correlation. So what's interesting here is that, the CRB index works inversely to that FXI chart that I showed earlier, which is in kind of an interesting anomaly. And so does the US dollar index. The US dollar index works inversely to that FXI shares piece. So those are the kinds of things that are important to note, because they give you really good clues about what's going to happen with metal prices. And it's why when we go back, we look at those charts that I just previously shared. Okay, we have a lot of content, so I'm going to stop sharing my screen and we are going to move over into the aluminum analysis. So with that, Stuart, I'm going to give me 1 second and I'm going to pull up the Insights platform. And in the meantime, feel free to get started.
Thank you, Lisa. Okay, well, that initial introduction there from Lisa has shown some, in graphic form, some very interesting trends that have been going on in the last year or so. The market, as any aluminium buyer out there will know, has been somewhat range-bound the last few months. We had a little drop and then a spike in June, but prices have been trending sideways, and they've been buffeted by a number of factors. Some of them are technical, like US dollar strength. And I think one of the interesting things from that graph that Lisa was showing us is that although the dollar has been on a weakening trend of late, it hasn't adversely affected the metal prices, which says that you would have expected metal prices to have risen, particularly aluminium prices to have risen as the dollar weakened, but they haven't. They've trended sideways, which I think actually is an indicator of underlying weakness in the aluminium market. Other things that have been impacting the aluminium price have been perceptions of the underlying fundamentals in China, Chinese demand particularly, and also the market has been buffeted by concerns about the amount of Russian metal on the LME, which I'll come on to in a moment. But the reality is the price has fairly reliably reflected the fact that it's broadly in balance. Supply and demand are broadly imbalanced at the moment, but the state of play there may be changing. We've written repeatedly over the last couple of months about the market's anxiety over the LME price, that it could be distorted by the level of less popular, let's say, Russian brands that is on the market, and that therefore the LME price may not be reflecting fair value. I think that has largely so far been misplaced, that anxiety. The delta between the LME and the CME has fluctuated over the last 3 to 6 months, but has remained broadly consistent. And that suggests that the LME, which has some 80% of the metal of Russian origin, and the CME, which has none, that the LME price hasn't been unduly distorted yet by that presence of that Russian material. But the volumes on the LME, on the CME rather, have been rising. And I think what that is telling us is that the North American market particularly is beginning to turn to the CME as its preferred choice. LME is still used in many benchmark contractual arrangements, but the CME is growing in interest, particularly amongst investors. And that in the long term, that could be at the expense of the LME price and the LME contract. But it is going to be a very long-term trend. Volumes are still a fraction on the CME of what they are on the London Metal Exchange. And back to Russia. Russia's pumping out some 4 million tons a year of aluminium, primary aluminium, and much of the exports from their production are finding a home in China. They're finding a home, as we just mentioned, on the London Metal Exchange, but predominantly in the Asian warehouses in Malaysia and in South Korea. And they're finding home amongst consumers in markets like Turkey and the Middle East, and even in limited quantities in Europe. Russian aluminium isn't sanctioned in Europe, only in the UK and the USA, but many consumers have self-sanctioned in Europe, and that in itself has caused some wild swings on their LME cash to 3 months price, as traders have fought for parcels of non-Russian metal that's still on warrant. Lisa, do you have that physical delivery premium graph we were chatting about earlier?
Sure do.
Okay.
Pull that up.
The demand remains weak. The physical delivery premiums reflect this, with the Midwest premiums being gradually declining this year in the face of massive overstock positions throughout the supply chain. The Asian market is more balanced, but the Q3 third quarter main Japanese port negotiations unusually ran 3 weeks over before they finally arrived at a decision at the end of June, and they fixed at pretty much the same price as Q2. One cause for concern that we have, and was probably shared by those Japanese buyers in the above contract negotiations, is China. A recovery in the construction sector has not happened. Manufacturing remains depressed, particularly any export-orientated activities. Consumer demand is weak, depressed, I think, largely by the housing market. China was a major importer of Russian primary aluminium in the first 6 months of this year, in part due to droughts in Yunnan province. But as the rains have come and production has picked up in China, imports of Russian material have dropped off significantly in the last couple of months, and that Russian metal will go looking for a home elsewhere, probably with a reduced price, much as Russian oil has been sold at a discount on the world market and depressed the oil price. Russian aluminium is probably going to find a home at reduced prices and will continue to be a dampener to the global aluminium price. So much for primary metal. Conversion premiums for semi-finished metals have also been coming off all year. They remained under pressure due to the overstock position among distributors and consumers. Lead times were coming in prior to the summer close downs and maintenance breaks that mills are having, particularly here in Europe. And while many producers are saying they expect the situation to improve from the end of Q3, beginning to Q4, I think it'll be the end of Q4, at least in Europe, before we see an improvement, probably Q1 of next year. Europe is going to be somewhat behind the US. The US may well get a soft landing. Europe is much less likely to that. While Chinese metals heavily tariffed against in the USA and Europe, it continues to displace Western mills' sales elsewhere and feed into overseas component manufacturer prices, depressing demand for Western mills and hence processing charges. That's likely to continue for the rest of this year as the central banks continue to tighten monetary policy. So for now, that sideways trend is likely to continue, but the risk is to the downside, with that excess Russian output potentially overhanging the market and continued high inventory levels, particularly of semi-finished products, just about everywhere, and a weak economic outlook in China and Europe. Our own support and resistance levels for aluminium are at 21.32 for support and 24.31 for resistance. That's quite a high resistance level. The average comes in at 21.98, and I think that 2100 to 2200 range is a more likely, personally, that's my prediction, is a more likely sort of range for the balance of this year. That's about it, wrapped up for aluminium.
Great, Stuart, I appreciate it. I had just kind of quickly gone through and thrown a should cost model in there just in reference to what Stuart had just said about conversion premiums and their trends. That's the piece that we track here in should cost models, and we cover a range of different grades. Okay, with that, I'm going to move on. Nicole, you are up. I'm going to stop screen sharing because I think you've got your own that you'd like to run through, so it's all you.
I do. Hello, everyone. I'm going to begin with a little outlook on the stainless market. Like Lisa had mentioned, the outlook for metals right now is a little bit unclear. I would consider it a sideways market, but it's edging upwards. As you can see, prices found a bottom or found a peak in January, and then they followed.
Hey, Nicole, real quick, sorry to interrupt. You're showing copper. I
Yeah.
just want to make sure we're talking about stainless. I think you said you were talking about stainless. So let's just make sure we're showing that screen.
Okay, I am talking about copper.
Okay, perfect. Okay, thank you. Just want to clarify. All good.
Yeah. So the copper, yeah. So the outlook for copper is a little bit unclear. I would consider it sideways. It has edged upwards over the last few months. As you can see, prices found a peak in January, and then they followed with pretty consistent declines during most of the first half. They found a bottom at the end of May, and then, as I said, they subsequently saw relatively modest increases over the past 2 months. While rising, the upside has lacked enough momentum to break through resistance levels. And when we think about that, it indicates a lack of trend strength, meaning that prices have yet to confirm a reversal. And so they're prone to either stagnating and moving sideways or retracing. Now, as far as what's impacting the copper market, the three big rocks I would say are China, the US, and the US dollar, things that we've talked about a little bit already in this workshop. Copper prices have consistently responded to news from China. They found a bottom in May as its manufacturing sector saw a short-lived turnaround, although the latest data showed that its manufacturing sector remains depressed. Additionally, hopes of stimulus have helped lift prices over the past few months. That said, China's announcement of a small cut to lending rates on part of the People's Bank of China saw prices retrace in late June. You can sort of see where it peaked here. That was shortly after the announcement, and it came down. But China continues to hint at more stimulus measures. Those have yet to materialize as China's growth has stagnated. All said, I would say that China poses somewhat of a volatility risk. Any announcement could at least temporarily see prices rally, unless, of course, they disappoint markets in terms of scale or outcome as it relates to consumer spending. Beyond China, the U.S. economy, and specifically the dollar, impact copper prices. Our own manufacturing sector remains in contraction, which has limited U.S. demand for copper. Additionally, while the construction sector remains strong, a number of funding delays continue to hold up infrastructure-related projects. The U.S. did recently add copper to its critical minerals list, which means it still has a strong demand narrative. And renewable projects, part of those, the infrastructure, will pick up demand for copper. But currently, there's no indication of when that funding will be released and those projects will begin. Likely, I would imagine it would be before the end of the current term for the president, as there's a chance the U.S. would elect someone different. But yeah, it's been slow so far. Meanwhile, the Fed and its impact on the US dollar has also been influencing copper prices. Cooling inflation data in July saw the US dollar index from the slide that Lisa had showed briefly drop below that 100 mark. And that saw copper prices push upward most recently due to the inverse relationship. By the end of July, however, the Fed ultimately issued another rate hike, and the dollar index returned within its longer term sideways range. This would suggest, and copper prices have come down a little bit, and this would suggest that should the Fed pivot and the dollar falls, it will add a renewed support to copper prices. There's no indication that the Fed is ready to do so, as core inflation remains pretty high, and so sustained and potentially higher interest rates will continue to weigh on the US economy. As far as our price forecast, we expect the average price to drop to $8,388, which is slightly lower than the current price of $8,517. We continue to recommend a conservative approach to the market, as there's no strong trend apparent yet. There are both some upside and downside risk, upside being a longer term copper shortage narrative, and the downside risk would be like economic challenges, both in the US and over in China. We should also never discount the possibility of a black swan event, something we've learned at the very least over the past few years, and that could dramatically shift the outlook. But like I said, the average price is forecast for lower than what we our current price due to the bearish risks. And we've placed resistance and support in from a long-term perspective at 9,258 and support at $7,876 per metric ton. I'm going to move over to stainless steel, and I'm also going to add in some commentary about nickel. So right now you can see on the screen, it should be the 304 North American stainless surcharge. So the surcharge has remained mostly bearish since it found a peak, and it's fallen almost 25% since February. Meanwhile, base prices have held firm since January 2022. So one of the things we like to look at are things that could indicate that or take the pulse of a market. And one of those things of late has been the fact that North American Stainless has issued no public news announcements about price adjustments in 2023. This compares to 4 in 2022, and that would be indicative of a much softer stainless market. And I found that to be true anecdotally in my conversations with service centers. Some have noted fighting for customers with like at a lower range. One service center currently reports that service centers are looking at a range for end users, which would include both the surcharge and a service center markup and processing fees at $2.05 to $2.20 per pound. Service centers continue to note limited demand from end users, with end users reporting high inventory levels that have prevented them from just buying within the market, and that has led to historically short mill lead times. As far as what our should cost models are telling us, currently they project a higher surcharge in the coming month as nickel prices have started to rise. I can switch over to nickel and we can look at that, and you can see the modest rise up until now. That said, I mean, nickel has the potential for a lot more supply to come online. Indonesia is currently experiencing a production boom, although most of that production will benefit the Class 2 market versus the Class 1 market, which is what the the price of the LME reflects. There is still an increased supply of Class 1 material coming. There's a lot of intermediate forms. There's intermediate forms of nickel in Indonesia being converted into Class 1 nickel, and additionally, the LME has been fast tracking new brands in order to accept material from different companies, and that is expected to lift inventories, which are quite low and continue to decline. As nickel remains the most volatile element of the surcharge, that means a downside risk to the surcharge. Our average price for nickel prices is predicted at 21,401. That's slightly below where we're at now. The nickel market continues to see pretty slow movement in terms of the loss of liquidity that happened after the crisis. That hasn't resolved itself. I think the LME is certainly hoping that it will at some point, but it hasn't really yet. And so that's led to kind of very not super meaningful trends, very slow movement overall. And like with copper and other markets, we recommend a conservative approach. Nickel prices show a lack of bullish momentum in spite of the recent upside, and with the downside risk of rising supply. And currently the upside risk is that the supply has not hit LME inventories yet, although it is expected to. And that could impact the surcharge in the short term. For resistance, we currently see it at $25,134 per metric ton, with support falling to $19,080 per metric ton.
Okay, Nicole, are you wrapped on your comments?
I am.
Okay, just want to remind everybody to go ahead and put comments in the chat. Don, I'm going to ask you to kind of bring it home with steel, and then I think the two of us can, and well, actually all four of us can kind of chit chat about some of the other specific sourcing strategies, maybe just 30 seconds on some of the things that we're seeing. I want to make sure I talk about China, so one of you needs to remind me to do that. Okay, Don, over to you.
Okay, thanks. So steel, kind of similar to some of the other metals. It's sideways to down. That's kind of in general a little softer, but some of the oddities that you're hearing, you're seeing some people out there saying, wow, I'm still having trouble finding steel. Not as a whole. I think that's kind of in pockets, but there is some of that out there, and I'll kind of show you why you're seeing some of that. And it's related to lead times and how they've moved out. So you can see here, we have the mill lead times here. Well, they remain really low. You're, 5.5, 6 weeks, which is totally normal. Anything around 6 weeks is historically normal for hot rolled coil, which is kind of what you're looking at. But when it was down here, when you're looking at a 3-week lead time, lead times almost double. So that can cause, excuse me, that can cause some shortages in the market. So if you weren't stocked all the way up, or there's some specific need you had and lead times doubled, although they're still really short, that can cause some shortages and trouble finding material in there. There was this kind of thought that this wall of capacity is going to come on and there's going to be steel floating everywhere. That hasn't materialized, and I'm not sure that it's really going to, especially with the consolidations that happened within the market the last few years with Cliffs and US Steel, Big River, kind of general consolidation in the market. I don't think there's going to be this huge flood of material that's going to be kind of detrimental to the price. You also have the tariffs, which I don't think are going away anytime soon, possibly never going away with some of those tariffs. It's something that probably is just going to stick around and help support some of the prices going through there. So the next thing that I want to talk about is the spreads. So it's something that I always talk about on these is what's the spread, what's going on between hot rolled and cold rolled. Hot rolled is usually your base, what's going on in the general market, and then it kind of goes out from there, whether it's cold rolled or hot dip, some of those type of things. So historically, the spread has been less than $200. If you look way back, it was 100 for a long time. Then it was kind of that 150 to 200, which is where you're at now. You're less than 200. You're probably 185, 190 spread between hot rolled and cold rolled. And that kind of tells me that those markets are sort of in balance. Is what you typically see is when things are coming up, that spread gets compressed, as you can see here. And then as it falls, that spread gets wider, as you're seeing through here. Right now, you're kind of in that 200 range. So that tells me it's kind of in balance and sort of gives a little more strength to the notion that it's sort of leveling out and going sideways. I mean, it's obviously dropping a lot from here, but you had the rise also. So that kind of pushes towards, I think these commodities are both kind of headed sideways. There's a couple different drivers here. When you look at cold rolled, you have appliances and automotive that are heavy consumers of that material. Automotive's still really strong. Kind of in my own disbelief, I thought that would really kind of come off by now, but it's not. Auto is really strong still. They're not making record number of cars, but they're still making a lot of cars. I'm talking to people that seem to be kind of sold out for capacity in certain areas. And so that's sort of helping keep the cold rolled coil number up. On the other side, you have products like appliances, home starts, and things like that have been down. Big box have been down, some of those type of things. So that's kind of weighing on cold roll on the other end. So I guess going forward, you kind of have to look at what do you think those trends are going to do going forward. It looks like auto is going to continue to be strong, possibly into next quarter, which will give some weight to that. On the hot rolled side, though, I think hot roll is probably a little softer than cold roll. They don't have some of those big industries to keep them afloat. I talked about big box. A lot of that is down. If you look at like lawnmowers, tractors, some of those big things that use a lot of metal and go into big box, I'm seeing a lot of that really soft for schedules, not only the back half of this year, but going into next year. So there's probably more downside risk to hot rolled than cold rolled. So that's kind of the spread. And I bring that up because there's different things you can do with contracting. If you're a cold rolled buyer, for instance, are you looking at some kind of straight adder to hot roll coil? Are you following the cold roll coil number? There's kind of different things to look at if you're a cold rolled buyer as far as a contract. So that's important to know the spread and where it's going forward, depending on how you want to contract there. So then I want to talk a little bit more broadly about kind of the four forms: hot roll, cold roll, hot dip, and plate. You can see this green line is plate. It's a serious outlier compared to the rest of them. They all kind of followed each other up. And then the rolled products all came down and plate sort of tapered off versus coming down. And now it's kind of flat going forward there too. It's a different market. I try to point this out a lot. A lot of times people think, well, steel is steel, and they all kind of follow each other, and they don't. And that's kind of what I'm trying to show here in this graph. The coil is all together in a pack, and this plate is out here. You have a lot that goes into the energy sector, wind farms, things of that nature that are using this plate product. A lot of bridges. I've taken a few trips lately, and it seems like you can't go more than 6 or 7 miles without seeing a new bridge or a bridge being reconstructed. Seems like there's a ton of bridge work out there, and that's a lot of plate product in there. So between the infrastructure, wind towers, some of those type things, you're really seeing the plate hang out up here, and I think that's going to continue. I don't see a reason why that would get softer. And actually going into next year, I could see that bumping up. My understanding is the infrastructure bill and some of the energy stuff, a lot of the funds come in buckets. You get like 2-year windows for your buckets, and they've used up a lot of that for 22 and 23, but then they get like a new bucket in 24. So there could be a lot more spending on projects that use this plate type material in 24, and it's already at an elevated level. Plate market's much, much smaller than coil market to begin with. So you get influx in demand like that, you could really see this kind of bump up. So on these forms, I would say the risk to the upside, the only one that has a big one is really plate. Hot dip galv, I want to touch on that just for a minute. It's kind of following everything which you would expect. It's hot rolled, committed to cold rolled, and then dipped. Zinc, there's a real risk to the zinc price. So zinc is probably one of the strongest metals that we're watching right now. It is kind of in those industrial metals that could really affect either just the zinc, the hot dip price, or an extra. A lot of times the mills will readjust their gauge grade type extras at the end of the year. So that's something to keep an eye on if you're buying a lot of hot dip galv. Those extras could shift for next year as they change the price pages and things like that, due to the cost of zinc. Along with that is scrap. So it's kind of the last component that we typically look at. Scrap is a little bit counterintuitive, as auto, it's driven a lot, not solely, but a lot by auto. The more auto makes, kind of the more downward pressure you see on scrap. that's because they just generate a massive amount of scrap as they're producing, their different stampings and things like that. There's a lot of offtake on the scrap. The scrap has come down. I think that will kind of continue to slide. I already talked about strength in auto, and the prices kind of sideways to down to begin with. So I think scrap will kind of continue to taper down. I talk a lot about scrap as a mechanism. I'm not sure that that's going to be good for next year. One of the things that you have to evaluate, though, every year I talk about, look at what are the trends going forward and what contract mechanisms line up with that trend. So it's definitely something to evaluate. Do you tie your contract to scrap versus finished goods in a market like this? That's probably not what you want to do. I think going out, it's sideways to down for most of these metals, maybe with the exception of plate, a little in hot dip, but that's kind of where those are at. As far as support, resistance, average, so we have hot roll coil at a support of 759 and a resistance of 1113. Keep in mind, this is still a little early. It's kind of preliminary numbers. You'll want fresher numbers before you go into your contract talks, but this is kind of where we're at, kind of sneak peek early view of where it's at with an average price of 811. So that's down from 852 where we're at now. It kind of talks to where the softening in hot roll coil is. On the cold rolled side, we have support at 909 and resistance at 1274 with an average of 944. Currently, you're about 1062. So I see that kind of softening, going right along with the hot rolled number, but not a cliff, not a huge drop off. Hot dip gal, you're 1052 and 1298 with an average of an 1111. Hot dip right now is 1080. So that's in there a little bit as a hedge for that zinc. I kind of talked about that a little bit earlier. So there is a little bit more of a possibility for uptick in the hot dip galv. And then there's plate. We have support at 1479, resistance at 1744 with an average of 1571. Plate right now is 1575. Really think going into the end of this year and probably the first part of next year, plate will be pretty flat. I think you won't see a real uptick in plate until those projects start kicking off and there's more spending. It's probably towards the middle to late part of next year. So that's why you look at 12-month out for right now and you're looking at plate kind of flat. So that's kind of my 2 cents on steel. Lisa,
Perfect.
Back over to you.
Okay, awesome. Perfect. Again, those numbers that all of us have been sharing are part of our annual Outlook subscription series. We release the actual forecast for 2024 in September. So the numbers Don Stewart and Nicole just shared are essentially preliminary sneak peek numbers, if you will, subject to change and revision. Even as we rattled them off this morning, we kind of noted some changes that we might want to make potentially down the line because things and market conditions obviously change. So with that, I wanted to share a couple of resources and things that we have available on MetalMiner that I think will be very helpful. First of all, we have a pretty comprehensive best practices resource page on our website. We are publishing a story a day, and then we have some very specific white papers around specific types of markets. There are little tips and tricks of sourcing. I encourage everybody to take a look at those. And then also a lot of the data that we've been sharing today, and we don't typically do a lot of data sharing this way, but we did for the annual Outlook, just because we know a lot of you are establishing your budgets for next year. We do have some of these reports are now available as a credit card subscription. We offer the monthly Outlook. This is the report that gives you all of the metals that we talked about, plus a few more, the non-ferrous. And the key thing about those metals is that it gives you a monthly buying strategy. So I'll actually tell you, what should I do in the next 30 days based on what the market is doing? And every month those are changing. Don hinted at zinc, as one of those metals that it has changed a little bit. But if you just need something for your budgeting purposes, we offer the annual outlook. It's a quarterly report. Again, the report comes out in September. If you signed up today, you would get the last quarterly report. It's very comprehensive, and it talks through a number of the things that we consistently talk about over time. Gives a lot more detail there, and you can subscribe to that as well. And of course, you've got questions in the Q&A here. Please feel free to reach out to any of us at any time. Happy to chat. And with that, I just want to thank you all for making some time for us, and good luck with your 2024 negotiations. Thank you.